Futures and options are inherently risky and not suitable for all investors. Only risk capital should be used. An investor may lose more than the original investment. Past performance is not necessarily indicative of future results.
All right, it's not Thursday because Matt won't be in his office tomorrow, but it's Wednesday. It's just past noon Central. Yesterday, in the 5-year notes and S&P, I had told my clients on my newsletter the night before that we had a real important price in the S&P at 13.53 quarter. And I told my clients in the room, I said, if you want to go for a grand slam, you buy the S&P against 53 quarter, and then you get short in bonds or notes. Now what I did is I got short in the 5-year notes. It's a less riskiest of the sector, all right, and it was a nice trade. Well, when I left the floor, I thought I should call Matt because he's my option guy and just see if there's a play I could put on. But after being on the floor all day and going through the battles, I was kind of done. I came up here today and I said, Matt, you know, was there a play we could have done where we're going to try and get short the 5-year notes yesterday, and this was on the close, okay, and buy the S&P. So that's why I'm up here. And one thing Matt had said to me was, well, it's doubtful you could have both done the same time. But he said, yeah, I got some ideas for you. So next time, I'm going to call him. And you know, I want to mention this too, because even though I was able to keep myself short the 5-year notes last night, this morning I got stopped out. Okay, and what's happening? I mean, you know, we've still got a weak 5-year market. We still got a strong S&P. But it's my belief that you can't trade longer term using futures. You got to use options. So Matt, based on that play I mentioned, was something we could have done?
Well, yeah, yesterday, looking at your newsletter, I found this very interesting. I was paying very close attention. You had a major up at 141.28, and I believe the high print was 27.
In the bonds. In
the bonds, that's correct. So bonds obviously running up into some resistance up there. Looking at the options, okay, something if you were bearish bonds or thought that major was going to hold, something you could have done in this case would have been to sell the June bond 145 call for around 46 ticks, okay? So in dollars and cents, you're talking $718 and change, okay, plus commissions and fees, all right? Now, before we get into further details, obviously, this is a naked option. You have unlimited risk, unlimited exposure, okay? You should only be using risk capital for this type of stuff. Now, had you sold that call yesterday, that call right now is profitable by about 10 ticks, so around $150, not including transaction costs, okay? Obviously, it could have gone the other way as well. We could have come in this morning, the bonds have blown through that major and they're higher and the trade is underwater. So right now that trade is working. That was one thing you could have done had you suspected that your level was going to hold, which in this case it did, okay? Looking at the S&P, we ticked down to, I believe it was 52.5 or 53 quarter, somewhere in there yesterday.
I'm pretty sure my price held 53 quarter.
Right, okay. If you were looking for a bounce there, okay, which obviously you were, but if somebody wanted to try and take advantage of a short-term bounce here in the S&Ps, they could have simply bought an April at-the-money call, okay, the 13.5 call. And you should have been able to buy that yesterday for somewhere around 20 points, 21 points, which if we're talking the mini S&P, you're looking at about $1,000 plus commissions and fees, okay? Today, market obviously gapped up a little bit higher today. That option has increased in value by 4 to 5 points, okay? So if you bought a mini S&P option, you've picked up a couple $100 on it. Now, again, this trade could have just as easily gone the other way, okay? But it is a case where your level did hold, and somebody who figured your level was going to hold, that is one way they could have potentially played it. So, you know, again, you want to keep in mind the risk, okay? The risk on buying this call is the premium you pay for it. So, you know, regardless of what happens, you can't lose more than $1,000 plus your